So on to today's topic. How many of you have underwritten a deal recently and just can't get the numbers to work with today's interest rates, which thanks to the Fed's heavy-handedness seem to be going up every month? Or how about those lower rate floating bridge loans that we've had access to that have those exorbitant rate caps now of 800 and higher? And then there's those of us that are looking for long-term fixed debt in a 7% range. Is it really worth forfeiting any upside on a refi or sale in 3 to 4 years or less, given defeasance or yield maintenance costs? Buying at a good price is always important, but in today's market, it can be tough. Maybe it's getting a little bit easier, so we'll see. So what's a multifamily investor to do? Are assumable loans a good option? So let's find out more. Welcome to the Greater Central Florida Multifamily Investor Group, where we focus on investing where it makes sense. Before I forget, and I guess while people are still getting on, don't forget to put your information in the chat. Just go ahead and copy paste. It'd be good for networking for sure. So if you have not had a chance to do so recently on the show, or even if you have, just go ahead and put it on there again. This just gives everyone an opportunity to network, which is part of what this show is about. So I'm going to go ahead and put my info in there. Let me welcome our guest speaker, Joe LaFleur. How are you, man?
My world is good. Thanks for having us on. I appreciate it.
Oh, it's my pleasure, man. I do this not just for others, but also for me, because I run this show, but I'm also an operator, and I'm always looking for deals and always working on networking with others to get this stuff done. And every day it's a new challenge, and we just have to be up for it.
Well, you seem to be succeeding.
We try, man. I know you're doing your thing, so it's good to get you on here. So as I mentioned, if you haven't had a chance, or if you popped in a little bit late, go ahead and put your information on the chat so that we can make sure that we network after this and catch up with each other. Any questions? Thought I heard somebody ask something. Or is it just me? All right. Well, let's do this. Let's go ahead and let me introduce Joe formally, and then we can go from there and make sure I get this right. All right, here we go. Our distinguished speaker, Joe LaFleur, a multifamily investment advisor with 100units.com, specializes in representation of multifamily buyers and sellers. Buyers and sellers throughout the Central Florida market. Sorry about that. Using his transactional experience, he has helped clients successfully close over, is that 350 million? Yes, 350 million in volume. Joe provides value to his clients with superior knowledge of the multifamily asset class. He views himself as an educator and advisor, working with many established investors as well as investors new to commercial real estate. He provides his clients with the highest probability of success using his thorough knowledge of all multifamily transaction aspects, including access to buyers, lenders, appraisers, real estate attorneys, professional property managers, and 1031 qualified intermediaries. Joe graduated with honors from the electrical engineering bachelor's degree program at the University of Houston. He holds a Florida real estate broker's license and is an active member of the Downtown Toastmasters Club. He has been happily married to Elaine for 20 years. Joe, that's my pleasure to have you on. I know you've got a lot of great information, and if time permits, after this show, I want to talk a little bit about what you're seeing in Central Florida in general, because I know you do this every day. So, Joe, the floor is yours.
Awesome. Yeah, delighted to be here. I want to start off right away, as everybody on this call is looking to invest better. And if there's one thing you take away from this, it's that there is no one size fits all. A lot of people think, oh, this is great or that's great. You have to, it's a compilation of all of the particular details of every investment that make it work good for you or not work good for you. And that's probably the number one thing I would like you to take away from this. So we're going to roll through the concepts of assumable mortgages, and also most importantly are the questions that you need to walk away with, where you're going to check, hey, does this work well for my objectives or does it not? Now we're going to find out in 2 seconds. Is this going to share my screen? The question is, share screen. And are we in business?
Voila.
Woo! We all get lucky sometimes. All right. This is a deal actually we closed like 30 days ago. It was called Lofts at Concord. It was a deal in Orlando. And this was kind of the situation where we had a buyer had 2 options. They could purchase the property for 1.6 million, or because of the yield maintenance of 150,000, they could pay 150,000 more and put new debt on the property. So the things that the buyer went through and asked themselves, does this make sense to assume the mortgage, or does it better to put new debt on? He went through, there's kind of the general stuff on the mortgage itself. It was like $1 million. It was just over 5%. It was a 30-year AM. This was a Fannie deal. It had 7 years left on a 10-year term. It was already in the amortization period. So the reason this is important is that there's always a number of options. And it's important for you as a buyer, when you're looking at a deal, to look at the options on the table and see which ones best fit what you're looking to accomplish. So in some cases, you're going to be in a situation where you need to place additional equity. So you're actually going to go and want a lower loan to value than normally because of X reason. In this particular case, this particular buyer had a situation where they had the amount of equity that actually made sense for them to assume the mortgage because of their equity situation. It's also going to be another thing you're going to check out. You'll be like, hey, for this situation, does it make sense? Hold period. So I'm going to have yield maintenance on off for another 7 years. Do I want to hold this asset for another 7 years, or do I want to be able to refi sooner? This is a big one. Is typically what you're going to see is that the IRR is going to be better with new debt, and the cash on cash may be better with an assumption. And it depends which of those metrics are better fit your objectives and the investors who are putting equity with you's objectives. Then, of course, there's also the other varying reasons that you may be buying real estate and may affect the deal. And it's important that you've thought those through, because sometimes people get excited about, oh, this loan's assumable, it's non-recourse, so that's a great fit, so I can get a slightly lower interest rate. But there's a lot of other things with a loan that it's important to make certain that they all line up with what you're looking to accomplish. And most importantly, what you've promised, especially if you've brought on equity partners, what you've promised them, and make sure that that lines up. So this is a quick example. In this particular case, the buyer went ahead and did the assumption, which was took longer than anyone had anticipated, but we got it done. He ended up getting a great rate of 5%, which seemed like a terrible rate a year ago, but it ended up working out well for him. All right, here's all the major players typically in the assumable mortgage space. All the agencies, Fannie, Freddie, HUD, life companies. I did a life company assumption recently. That was an interesting one because it had partial recourse, and so we had to work something out for that. CMBS deals, so all of your commercial mortgage-backed security deals. Typically, I've done those. And then other lenders, typically bank loans and recourse loans is very difficult to have an assumption, because part of the collateral the lender is looking at is the actual net worth and security of the borrower. So it's a lot harder to pull off those as an assumption. And typically you wouldn't want to do it unless there was a very specific set of circumstances that lent it to that situation. But those are your general major food groups you're going to see on a regular basis. When you're going to make an assumption of a loan, you need to go through all of the underwriting criteria and make sure that that loan fits up with what you're looking to accomplish. So you're going to look through, hey, are you going to you're going to conform and make certain that the loan balance is, what the interest rate is, what the term is, how long the interest is fixed for, whether there's interest only still burning or has it all burned off, whether you're in an amortization period, a 20-year, 25-year, 30-year, maybe more amortization. Are you at full interest only for the term of the loan? Is there recourse? So you have to be, this is something to be cognizant of, is what are you signing on? Because some are partial recourse, non-recourse, some only have bad boy carve-outs. So it's important that you look at it and say, hey, does this fit my objectives for what I'm willing to sign on? Yield maintenance, prepayment penalty, those are going, you're going to inherit each one, every one of those. Is that something that you want? Does it fit your time horizon? Are you looking to hold this asset for some years? Are you looking to sell it, refinance it? I've added in the servicer of the servicing lender, specifically because let's say you have a long history and you've done 7 deals and all of them have been with, I don't know, I'm just going to randomly pick Arbor. You have a great relationship. You know them very well. Well, if this loan that you're assuming is with CBRE, guess what? Your lender is CBRE. There is no change in it. You now are going to deal with CBRE. That may be a great thing. It may be a terrible thing. It depends on how you get along with them, but it's important so you don't just take your dealings with Arbor, Walker, CB, whoever your loan is with, and think the idea that all of them are going to be the same. Different servicing lenders have different inspection criteria. They come out and check your property on a different schedule. They communicate with you different. They have expectations of your communications with them that are different. They want rent rolls on a regular basis. They want P&Ls. Do they want to know what's happening with unit turns? How are they going to hold reserves? That's another big one to keep an eye on. They have different reserve amounts, different requirements, and different requirements to get those reserves released after you've reinvested in the property and fixed it up. And it's very important that if you have experience with one particular servicer, it does not necessarily translate into the others. Always do a comparison to available new debt. And this goes whether it's seller financing, assumable financing, whatever gets you non-recourse, always check what your other options are to make sure that the direction you're picking aligns as good as possible with what you're looking to accomplish and your investors are looking to accomplish. I've seen a number of people get all excited about this is a non-recourse assumable loan, and they go down the road when for their objectives, it would have been better to pay the prepayment penalty for the seller and get new debt because it would have fit better with what they were looking to accomplish. So it's very important that no matter what you look at, you go comparison, existing debt, new debt, and make sure that which one is actually going to be better for you. Because in the eyes of the seller, as long as they're netting the same, it doesn't really matter. Loan to value. Now, this is one that was a big deal for many, many years, for the last probably half decade. It has now, because current new debt lenders are cutting their LTV, it's actually coming more in line with some assumptions that you can do. You got cash on cash return and internal rate of return, and those two things really matter because they are going to be different based on new debt versus the assuming the debt, and make sure that those two calculations match up with what you're looking to accomplish from a return objective. The one that I skipped over right in the middle is the supplemental. That is a really nifty tool that you should be aware of. It is available for Fannie deals, and HUD, Freddie Mac, they all have their varying versions. Even life companies do supplementals. And it's important for you to know about them because they can be used to bridge the gap to bring your loan to value up to where you want it to be to match your objectives. And it's important to understand that that's available. Once you know that it's available, you need to go and make certain what the actual criteria are. because typically they are not going to just give you the same interest rate of what the other loan is. Typically, there's going to be a premium that they're going to charge you, and it's important that you bake that into your blended rate. They're also going to have certain restrictions. It may tell you, oh, don't worry, it's 80% LTV. Somewhere else, it says what your debt coverage ratio is. Most likely, your debt coverage ratio is going to be your constraining factor. And it's very important you look at that beforehand, because typically once you go in the assumption process, you're going to be writing a check to the lender for give or take 1% of the loan to start the process. So it's important before you start spending money that you know exactly what you can get into. The other things to know about assumptions is they are going to rigorously underwrite you as a borrower. A lot of people think, oh, I'll just assume the loan. If you are a greater credit risk than the current borrower, they're going to be extremely hesitant to make you the new borrower. Because from the lender's side, there's no real advantage for giving up the current borrower to go to you, because they're getting the same interest rate, they're getting the same payment schedule. So if you are adding additional risk to them because of some history you have, or your balance sheet, or your lack of a balance sheet, know that they are going to be very hesitant. So they are going to underwrite you, in my experience, more tightly than when you're going in for a brand new mortgage. So it's something to be cognizant of, to make sure you have everything lined up. If you need additional equity shown, if you need liquidity, you make sure you have those people on your team before you even start the process. Because the last thing you want to do is start the process with a lender, have them come back and be disappointed, and then you have to come back with a new partner or something. Know ahead of time what their criteria are and make sure that you exceed that. So there's no question about going through it. Nobody wants to go back and try it again and spends extra time, and it adds disappointment for everyone. All right. Most of the documentation that I can find across the board on assumptions is 60 to 90 day period. So far in my history, the fastest I have seen an assumption done is 90 days. And that was a world record. That is the fastest I have seen it done. The longest so far has been CMBS deal. It took 9 months. So I would be cognizant, just because some piece of paper says, oh, don't worry, we can do it in 30 days, 45 days, 60 days, 75 days. So far, I have not seen it executed at that speed. And it's typically because the underwriters who are writing new loans, they are in the trenches every day, pumping through new loans. The team that underwrites an assumption, this is a one-off thing for them. This is not their normal every day. They don't get compensated the same way. They don't have the same incentives. They're on the slow boat. They'll review a bunch of documents, twiddle around, you call them 3 times, then they're, oh, we're missing this. So you get it to them. So it's just very important that you understand the incentives for each player. And if there's no incentive for them to get this done on time, they ain't in a hurry, because they have their own set of issues they got to deal with. I am going to make a recommendation that a lot of people do not do because they want to save the fees. I would recommend hiring a mortgage broker and paying them to shepherd your deal through this process. The amount of paperwork that you are going to be required and the seller is going to be required will be more than a new loan. And if you're able to engage a broker that has relationships within that particular servicer, it will pay off immensely, because they will be able to move your loan through the process much faster, which makes it better for you, better for your investors, and better for the seller. It's something I see a lot of people try and save 10 grand by doing it themselves. And 3 months later, they still are waiting to get things done. They're still getting questions, and they're very frustrated. And I've seen that happen multiple times on deals, where if you can engage someone who has relationships within that servicer, they pay off immensely in speed. This one you can learn from some personal experience on my side. Every now and then you have to pay the stupid tax and really get bummed out on a deal. We've had a situation because of the time frames where they took significantly longer to do the assumption than what it was supposed to. So I'm going to strongly urge you to have your attorney write up the contract and the assumption clauses to make sure that they extend out to the time the lender needs. What you do not want to do is end up in a situation where you have a very specific time frame that the lender is not in a hurry and does not at all conform to. And then after doing months of work, the seller decides, hey, you know what? I got a better offer from somebody else. So thanks for all your work. Really appreciate it. But I'm going to go with this other offer. And just trust me when I say, have an attorney write it up. That way you have the time and they're going to be there to help you. Because if you are in a market where they're getting multiple offers, that is going to continue, even if you have it under contract. And so make certain that you do not save money on your contract or on your assumption clauses, because that can be a very expensive lesson after 4 months of trying to do an assumption. All right, this, I got to give respect. I don't know if y'all follow Old Capital podcasts and James Ng, but they put out ridiculously good content for multifamily lending. Like, I have been incredibly impressed with all of their stuff. So if you are not following them and check out their YouTube channel and staying on top of their monthly updates, I would strongly recommend it. If you haven't read the book, What Every Real Estate Investor Needs to Know About Cash Flow, that is a book that is an absolute must read for anybody getting into the real estate business. It has every return calculation that you will need to know and explains it in an extremely straightforward and easy to understand manner. And finally, I got to do, this little selfish plug for our own website. We got a ton of resources for everything you're looking for, from vendors to videos on adding value, doing loans, doing 1031 exchanges, all of it at 100east.com under the resources tab. And that's what I got for assumptions. So we got any interesting questions floating out there about loan assumptions or the market in general?
Joe, I'll let the crowd start formulating their questions and they can jump in. Quick question from me. Talk me through a scenario where it's advantageous to go with a longer term fixed debt now. I know you mentioned that there were, there's always one possibility and another. Where in your estimation, or I guess experience, is that more valuable, taking the hit up front on the rate, et cetera, versus trying to do an assumption outside of the time factor? Let's just throw that out and say we've got the time to do it that we need. Lenders, the seller is going to agree to that within the loan as far as any extension or lender terms or lender clauses in there that will allow us to work through that process.
So there's a number of, remember, there's a number of variables involved. So the interest rate is one. Let's say the assumption is a better interest rate. It was taken out and it was a 10-year deal and it was done in 2015. So it's an attractive interest rate. It's amortizing. The LTV, though, is going to be really bad if it was taken out in 2015. So you got to have a ton of equity to bring in. So that may be a reason to look at new debt that even has a higher interest rate, depending on your LTV. Let's say you can get the supplemental to make up the difference. So the supplemental is typically going to be 75 to 100 basis points higher than current market interest rates. So depending on how that delta works out, let's say that's also good. It was a 10-year deal in 2015. We're now running right on to 2023. That means your clock is ticking and it's ticking fast. So now you're staring down a balloon in 2.5 years, to me, that would be something I would be very hesitant to do unless you had some real confidence in your abilities to refi, or your crystal balls about the future is way better than mine. So that would be one potential reason. Now, I have seen people do exactly that and come out extremely well because they had a plan to execute on. They knew exactly what they were going to do. They were able to take over the asset. They had an exit strategy that worked out well. And they had a backup plan in case all else failed. So I have learned over many, many years that just because I don't know how to do something correctly doesn't mean somebody else doesn't know how to do it extremely well. And deals that I thought made no sense to me, I couldn't figure them out. They like literally made no sense. I thought the people were crazy. Well, turns out I was wrong and they knew exactly what they were doing. I just didn't understand the way they could execute. So also the other side of it, maybe for some reason you just like, you think that's the greatest property in the world and you want to purchase it and put it on a 20-year fully amortizing loan. And you want 20 years from now, you want to still own that property and you want it paid off. So it just depends on your investment objectives and what you're looking to accomplish.
Gotcha. I would think that, yeah, if you want to hold it longer, then you have some, you can burn off that prepay, and you can burn off any defeasance over time, and then be clean. But if you're trying to do something short term, I think that's where it gets tougher. And then let me ask you this: what in your experience, do you see lenders on any assumable type products have an issue with essentially the seller being the pref or the supplemental, if you will?
That is a lender by lender question. So the answer to your question is I have actually executed those deals and closed on them. Now, how exactly they're done is unique to each lender, and you have to have a lender who's on board with that idea, and you have to have a buyer who's on board and a seller who's on board. So it takes multiple parties to be able to make those happen. And typically you have an exponential level of complexity the more parties you have to play around with in that. But I've actually been involved in transactions that are just exactly what you're describing right there.
Okay.
And, they worked out great for everybody.
Yeah, I think that's the key, right? Win-win. I think the seller maybe gets a little bit higher price than typically the current cap rate would dictate, but then they help out on the LTV side. Okay. Any questions from the audience?
Jenny, what's happening?
Hey there, how you doing?
My world is good.
Thank you for doing these. I like it.
Oh, good.
I hope you don't mind us kind of sharing data in the chat too.
No, ribbit.
Okay. Hey, I don't know if you said it at the beginning there. How often are you getting sellers that are willing to hold a note to begin with, or to give up? There is a risk for them to do the assumable, so to speak, too. So what percentage of the deals would you say are either of those? Whether it's cash,
That's a good question. Let's see. Seller financing deals. I closed one this year. I closed any more than that? I closed one of them 60 days ago. And I'm trying to think if I closed another one. For some reason, I think we closed another one earlier this year. I can't remember. Anyway, max 2 out of 30 deals. To give you an idea, like they do exist, but they're few and far between. I mean, it does happen, but
is
not
it
that
okay?
often.
So is it they're just ready to sell and fed up with the property, or is it that, because to me that is like the perfect solution. If you've loved this property and held it, especially for a long time, the value of it, you're not going to lend more than you would want to. I think that's a smart move personally, but
So the answer to your question is just like every buyer has certain objectives they're looking to accomplish, and depending on the mix of the situation, different things fit better. Sellers are also the same way. Thinking that every seller is the same and wants to accomplish the same thing is a strategic error. Each specific seller has their own ideas and own goals and own things that they want to achieve. And there's a subset underneath those where seller financing is a good fit for what they're looking to accomplish. Then there's a subset under those who will understand it and actually be able to execute on it. So you have to weed through all those sellers to get to the ones. There's plenty of them that, to me, it was a great fit, and they absolutely said, not no, but hell no, are we doing it? I refuse. I will never, ever, ever, ever do that. Okay. But to me, with looking at what they were looking to accomplish, they were literally going to pay the taxes and then go put the money in a, CD, which I'm like, you're going to get a better interest rate, better cash flow. Man, good luck. Like, some people, absolutely not. Other people, yeah, that sounds great. I always wanted to hold seller finance. Perfect. I will give y'all a word of advice. This is something I've had a number of buyers do, and I would like to help you be as successful as possible. Be cognizant of how you introduce a request for seller financing or an assumable mortgage into the conversation with a listing agent or a seller, because it can very easily be heard by them as, hi, I'm Joe. I'm totally broke, but I want you to help me buy this property. And it can be an instant turnoff. 1 nanosecond later, you just, okay, thanks so much. Got to go, click, and the end. You ain't never going to hear from them again. So be sure that you have thought through how you want to introduce that into any kind of conversation. And I will strongly recommend, if you are buying a property and you don't have a long relationship with your counterparty, you start off instantly by allaying any fears they have of your ability to execute. If I was walking in and walked into a broker's office, I'm interested in their listing, I called them up, or I would, in 1 second, I would say, hey, I got your email address as Joe at 100 Units. I'm sending you a picture of my bank balance sheet right now to show you have the money. These are the 3 transactions I've already closed in your marketplace. And I wouldn't even say hi. Now, then the person wants to listen to you.
Yeah, I've seen it where, I mean, normally I got to think you'd be well into the LOI and maybe even the PSA phase where before you went into something like that. And it would have to be, situation dependent, based on how long it took to work through the PSA and whether rates have changed. Something has to have changed for it to kind of, be introduced. But you're right, it would come off wrong if you just
I have seen people execute it well. I have seen many, 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 many more people execute it in the, hi, I'm broke. I don't have $3, but I want to buy your property.
Yeah, and I think a golden nugget is for those that are thinking that we're just going to go run around and do some assumables, to understand the fact that your qualifications actually have to be stronger than the seller is something that needs to be heavily considered. So that was a great point. Any other questions?
You're going to find out after 4 months of wasting your time and spending thousands of dollars.
I have a question.
What do you got?
All right. So maybe you talked about this, but I didn't quite catch it. Is there a fee when you assume a loan, a transfer fee or some sort of fee like that?
For the majority of lenders, they do charge an assumption fee.
Okay.
And you may have to also pay a broker's fee, depending on how their loan is set up. And depending also how it is, you may end up owning doc stamps, depending on how the note is set up and recorded in which county and state.
And is there like a common fee, or does that vary per lender?
It varies per lender. I mean, I would estimate just off the top of my head is 1% of the loan amount,
Okay.
but that's, you know, a guess.
Gotcha. And then second quick question, hopefully. I've seen a few deals where they have a partial recourse, typically 25%. Is there such a thing as a assumable non-recourse loan?
I would say the vast majority of them are non-recourse. Now, and that excludes bad boy carve-outs, you know, like fraud or whatever.
Sure.
But, you know, Fannie, Freddie, and HUD, all of them are non-recourse. The vast majority of CMBS are non-recourse. Life Cos and some CMBS are the partial recourse varietal typically. But there's a, you know, there's a flavor, you know, whatever. There's every color of the rainbow out there.
Gotcha. And then you talked about the very stringent criteria that some of the lenders have. Can you talk about some of them, if you can?
So just to give you the easy ones are Fannie, just because I've done a bunch of Fannie deals in this universe, and that's you need to show liquidity of typically a year's worth of payments. You need to show that your net worth is greater than the loan amount, or whoever's signing on the loan, to be able to cover it and sign the bad boy carve outs, experience in the marketplace that you're investing in. I'm trying to think if there's any other ones. Those are the ones that popped in my head really quickly.
Cool. Great presentation. Thank you.
Oh yeah. Awesome. Vessi, what do you got?
Joe, hi.
I know you pronounce your name. I'm sorry.
Yes, no, you pronounced it perfectly well.
Oh, wow.
So thank you, and a great summary. Really enjoyed seeing it and listening to it. I have a two-part question related to seller expectations, particularly with the loan assumption process. Just based on what I'm hearing, the timelines that you outlined are closer to reality than some people like to think. So question is if sellers' expectations are aligned. And then secondly, are you seeing sellers' expectations starting to adjust in the current market environment?
That is highly seller dependent. So some sellers, yes, some no. My favorite ones are the ones that, no, my property's worth more. So yeah, I don't know what else to tell you on that one. It's like the seller financing situation. You got a whole set of sellers. They got 87 things they want to accomplish. There's some subset that fit whatever it is that you're trying to accomplish. And when you can find those two things to match up, then you got a deal. But the rest of them are, you know, it's like dogs and cats.
Thank you.
Man, everybody else, all your questions have been answered in the entire universe. That's exciting. Yeah.
I've got another one, actually.
Oh, what do you got? Shoot.
Are you getting any kind of a uptick from people that are maybe that didn't sell before or whatever? I mean, people that are realizing they probably missed the boat that want to hurry up and sell now. Any kind of indication that there's some of that going on?
You know, we're doing, I would say we're doing about 15% more BOVs than we did over the last, like if you did a 90-day moving average. So you could argue that that is an uptick in people looking to sell. Of those, I have not, however, had a ton of the listings hit the, like actual people, you know, get out their pen and say, okay, let's do this. I've had a lot more people, I shouldn't say a lot more, but it's like we're running like 15% more than what we were over the last 90 days and asking, what's my property worth? What kind of debt could a buyer get? Then they're asking what debt is available for them. I've had a ton more of the more what's my property worth and how are things affecting them conversations than actual Joe, let's, I'm ready to go. I mean, it's just like buyers are asking, hey, where's the current market and what are things going to look like moving forward? Plenty of owners are in the same situation where they're not certain, and it really is dependent on what they're looking to accomplish. I had a conversation with a seller, I don't know, a couple hours ago. I was talking to him and he's like, well, I got this deal on the table. Do I want to do that? Do I want to spend money renovating and hold it? And it was really, I just talked to him, look, it just depends where you think it's going to be in 2 years, what you think your opportunity cost by keeping on do that, or is it better to just pull the trigger, take the money, sell it now and go do something else with it? And it really comes down to their particular objectives as to what will best suit them. And my favorite question is, well, where's the market going to be in 12 months? Because I think I'm going to sell then. Man, I ain't got no idea.
Come on, Joe. That was my next question, man. Or actually, I got a couple questions from Javier.
I always check the magic 8-ball, and every single time it says the same thing. It says outlook is good.
Just have some runway, right? I mean, that's the key. So Javier's got a couple questions. The first one is, when you assume a loan, do you also assume the entity, the owner entity on that, or is that something that you can transfer to a new entity?
I have never seen one done where you purchase the entity. I guess, I mean, it could be done. That would be one way to make that happen. Typically it's a new entity and you're a new borrower and you take over the loan from the other existing entity. I would be very let's say this, I would be very careful of treading into a situation where the seller was selling you it and he said, here, just buy the stock in my LLC and take over the loan. That's something I would definitely have an attorney do some serious investigation before I went down that road. Because if you pick up that stock, you now have also just picked up every liability that was associated with that LLC throughout all of history.
All the back.
It's something you should be, I would go into that extremely slowly.
Point. And then the other question is on the insurance. Do you typically have to reset the insurance, or is the existing policy just transfer over?
Most of the time you end up having to get a new policy because you become a new buying entity, a new ownership entity that owns a property. And so typically you're going to go out and get new insurance, and in current rates, typically that's going to cost you more than the existing insurance. And so that's something to be cognizant of.
Good questions, Hav. Anybody else have anything? If not, we'll transfer over. I want to talk a little bit about Central Florida market. Pause for a second there. Okay. Well, Joe, I know you don't have the magic 8-ball and your cell phone just says it's always good, but tell me a little bit about what you're seeing. I got on a show last month, and my thought was, and this is sort of tied to the hurricane. At that point, it wasn't Nicole, it was the previous hurricane. And so my thought was that we were going to see, because of volumes gone down so much, that I didn't think that pricing was going to be so impacted by that. And I was more talking about single family pricing and how that impacts multifamily business, right? And so that was my thought, that we would see essentially upward pressure here locally, not necessarily higher prices, but certainly not much lower prices than what we've seen because the volume has dried up. Is that what you're seeing? Or maybe you can just tell me if that's different than what your experience is right now doing these deals.
I have not seen a major drop off in pricing yet. And that may come, it may not, it depends. I have seen, just to give you an idea, transaction velocity is down 55% third quarter over third quarter last year. And year over year, it's down 40%. So the number of deals being executed in Central Florida is down significantly. If you go over to Tampa Bay, they're down 70% Q3 over Q3. And that's in the multifamily space, 5 to 150 units that we play in. Jacksonville is at about the 50%-ish range, roughly the same as Orlando. What I haven't seen is a major drop off in pricing, but the number of deals actually getting executed has dropped significantly. And mainly what we're seeing is the bid ask spread. So the price a seller will sell at and the price a buyer will pay that gap is getting wider and wider. So instead of, to give you an idea, like it typically will take a deal out and we'll get 12 to 15 offers. So the last deals we've closed, we were between 5 and 7 offers. And some of them were at the price we could transact at and some were not. And we'll see how that plays out. But we are seeing less buyer interest. And the buyers are very concerned about their ability to get debt that makes a deal make sense. Because it's super hard to buy a deal, 5 cap, borrow money at 6%. You better have a very good vision for that property or some reason you'll be able to impact. We have an excellent story in Central Florida. I mean, in Florida, we got 3 of the top 5 markets for rent growth. We've had some of the top rent growth in the country. Orlando's number 2 in the United States for rent growth. So we have some really good stories. But if you look at the trajectory, so in Q1, rent growth in Orlando year over year was just over 24%. In Q2, it was 18% year over year. Q3, it was 9.4% year over year. And that similar slowing of rent growth is the same thing you're going to see in Jax and also in Tampa Bay. So the margin for error is shrinking.
On what you're seeing as well, I'm assuming that you have a lot less buyers that are coming in with hard money. I think that would be kind of crazy right now, and probably similar on not having any kind of lender contingency.
It depends on their situation. We've had some that did exactly that. And we've had others that note they wanted, they didn't want any hard money. They wanted due diligence. They wanted contingency for financing. So it really is dependent on the buyer and the buyer's objective and their situation. Because we've got some of them where they're motivated to close this year because this year you still get 100% bonus depreciation. So if you're in a tax situation, we're going to be writing a check for $300,000, $400,000 in taxes. You have a tax liability that's obviously coming. I mean, we got another 45 days to the end of the year. You know where you're sitting tax wise. If you're in that situation, you're like, wow, I'm going to be writing a huge check. It's a lot better to go close a deal now and overpay for it because you basically get 50% of your down payment back just in tax savings. So it's really situationally dependent. And then you're going to lose a good chunk of it. You're going to lose 20% of that roll if you wait till January 1, because it's going to be 80% bonus depreciation in 23. So there are varying reasons for buyers to execute now and quote unquote overpay. Other ones are also tax deferred exchanges. They happen to have sold some asset because of X or Y reason. And now they got a lot of money in an exchange that makes sense for them to move on. Or I've also run into some of them who have a very particular plan for a property. Like they have a reposition that they're able to execute on a really heavy lift, and they've got a history of being able to do that. So but the buyers have just, shown up, maybe I'll buy a multifamily they're out of the market.
I've got a question from Jay asking what you're seeing from the foreign investors in this market. Are you seeing any kind of trends up or down?
So we've closed a number over the last 12 months. We've seen a slowdown in foreign investors coming into the U.S. And it's mainly just dollars super strong. And so you're not getting any bumps at all. We've seen typically actually net sellers from foreign investors is my experience. And right now, I'm trying to think if we have any deals under contract with foreign. We don't got nothing. We closed a couple last quarter, but that was it. Yeah, we've definitely seen a slowdown in foreign investors. I mean, over this 12 months, they have, for our experience, are net sellers.
Good info. Anybody else?
I mean, why not? I had some of them that made as much money on the property as they did the exchange rate. So they're like, this is great.
Arbitrage is something else.
I will also give
Looking
you
at Medellin, man.
insight.
Medellin looks good to me right now.
You got to match their situation because the tax laws in each country are different. And some of them allow 1031 exchanges, some don't, some have varying tax consequences when you bring money back, when you have a sale. So it's very important that you may not have knowledge of it, but make certain that they've thought it through. Because the last thing you want to do is do a deal with somebody and then they're 1 second from signing the closing documents and all of a sudden, whoa, surprise.
Yeah, I make a point to refer them to a CPA, somebody that works in their country that can kind of figure out what the best angle is for them as far as how they set up their structure. Because yeah, you definitely don't want to pretend to be an expert in that, because that is very, very, country specific and even investor specific, really.
Yes, that's a whole nother level of complexity.
All right, what else? Anybody else? Okay, I think we killed it. Joe, this has been good, man.
All right, awesome.
I don't think it's turned me off from looking for assumptions. I think what it has done, it's allowed me to kind of make sure that my team and I are a little bit more prepared, maybe on the qualification side, whether we need to bring in another balance sheet person up front or a key principal, and then make sure that we have those contingencies for the extensions that we need per the lender, because I'd hate to fall out of contract.
Oh, trust me, it ain't fun.
All right, well, good. Thanks, Joe. I appreciate it. Before we hang up here, I just want to remind the folks that are still on that our next show is December 12th. Our guest speaker is co-founder and vice president of investor relations of Avestor, a private fund management platform. And this allows investors to kind of pick which investments they want to invest in within that platform. So it'll be interesting. It's a little bit different, it's a little bit nuanced. So I'm hoping that for some of you that really like to get into, I want that deal or not that deal, but I like that group, this is an opportunity to maybe figure out and get into some more specific investments. So I'm going to leave it there, but I do want to remind everyone that you always want to invest where it makes sense. Thanks, everybody. Thanks, Joe. Appreciate it, man.